Hello my friends! I'm glad to welcome you to my video. Today we are covering a very important topic that most beginners ignore: how to properly choose a currency pair and the trade amount. This is critical because many traders make the same mistake. They select the first available pair and place an arbitrary trade size. They trade with $5, $10 or $20 without considering their deposit size. This reflects poor risk management and a lack of strategy. Trading success begins before entering a trade. It depends on choosing the right currency pair, its volatility, payout percentage, the risk you are willing to take per trade, and how predictable the price action is. Today I will provide a complete framework for selecting a pair, explain the risk formula, and finish with a concrete trade example and full technical analysis. First, we always check the payout of the currency pair. Here it is, 92. You may also see 89%, 87 or 79%. Each pair on Pocket Option has its own payout percentage. It is best to trade pairs with payouts between 80% and 97%, without sharp spikes and with stable performance throughout the hour. If the payout is low, consecutive losses are difficult to recover. Choose 80% or higher. This is essential. Next, select pairs with reasonable volatility. Pairs that move too sharply generate many false signals. Pairs that move too slowly provide too few opportunities. The optimal balance includes pairs such as euro and dollar, euro and British pound, euro and Japanese yen. These pairs respond well to levels and allow for solid technical analysis. We do not choose randomly. We approach this strategically. Another common beginner mistake is trading during major forex news releases. At those times, candles become very large, price fluctuates sharply, levels break, and analysis stops working. Always check the news using any economic calendar and avoid trading during major news releases. Trading requires a comprehensive approach. Chart analysis and economic news analysis both affect price. You must also choose a pair with a readable chart. When you open a chart, check whether levels are visible, whether there is a trend, whether pullbacks are clear, and whether structure exists. If the chart is erratic and candles are chaotic, switch to another pair immediately. For example, on dollar and euro, we set a 1-minute chart and then review the 1-hour time frame to understand the overall trend. The trend is upward. We draw a trend line. Despite a previous drop, the hourly trend remains bullish. The chart is clear and structured, with a visible correction. On the 1-minute time frame, we see upward impulses, 3 candles, and current consolidation. The price is likely to reach this level soon. It has already reached and even broken it. The chart is clear and predictable. Now, how do we choose a trade amount? This is the most important part of risk management, the rule 2-3% of the deposit per trade. In short-term trading, distance matters. If you risk 10-20%, you will burn the deposit very quickly. With a $100 deposit, the trade size should be $1-3, no more. With 500, trade $10-15, with 1000, trade $20, $30, and so on. The formula is simple. Deposit multiply 0.02, 0.03. This is a strict professional rule. You can even start with 0.01. This protects your deposit from random losses. One loss and streak will not destroy an account. You trade calmly, without emotion, and can place 20-30 trades per week while remaining profitable. This must be treated as a fixed rule. Now I will open a trade in real time and show my technical analysis. We will work with euro-dollar. We start with a 1 hour time frame. Draw the trend line and confirm the upward trend. I choose this pair because the chart is clear. An upward trend with a minor correction and small downward pullbacks. We mark the bottom. On the 15-minute time frame, we see bullish candles with wicks and a minor downward impulse, which is not significant. If the candle extends further, an entry is possible. On the 1-minute time frame, I wait for a small pullback and enter a buy trade. We do not rush. We identify the pair, understand the chart across multiple time frame, then open the trade and wait for outcome. Avoid chaotic pairs. They make technical analysis difficult and increase risk. Stable pairs with clear structure are more profitable over the long term. There is a small downward candle now, but it should stabilize within a minute. I do not expect the price to stay below our levels for long, so we wait calmly. The upward impulse is confirmed. The dynamics are clear, and technical analysis is straightforward. I recommend always using candlesticks charts. Oh, the trade closes with a solid profit. Congratulations. Now let's look at dollar and Japanese yen. Here I see some chaos, uneven lows and complex pattern. On the hourly time frame, there are sharp breakouts, sudden drops, and unstable movement. In this situation, you can clearly see the difference between the euro-dollar chart and this pair. I would not enter even short-term trades because there is some market chaos, sharp declines, and an unstable candlestick pattern. The market can move in any direction due to the candle size and wicks. I don't recommend entering this pair, and I will not open a trade here. To summarize, we choose pairs consciously. If the chart is clear, then we trade. Next, we check the payout. Anything about 80 is acceptable. Pairs with payouts around 62% are immediately excluded. Their charts are chaotic and technical analysis is unreliable. Look at this, I don't recommend entering here. The payout is low, the chart is unpredictable, and proper analysis is difficult. This is not gambling. This is trading for profit. We avoid pairs, low payouts, with low payouts and unpredictable price action. We focus on pairs without sharp spikes, with payouts between 80 and 97% and stable hourly performance. But I don't see that here on this hourly chart. We select pairs with balanced volatility, not too aggressive and not too slow, and always monitor economic news. In conclusion, this approach protects your deposit from random losses. One bad streak will not cause serious damage. You trade calmly and strategically and can achieve dozens of successful trades per week, which is far better than hundreds of losing ones. If you follow the 2-3% risk rule and choose pairs with normal volatility, your trading will become significantly more stable. I hope this video was useful. I look forward to seeing you in the next videos, where we will cover more trading topics and working on the Pocket Option platform. Good luck and profitable trading!